credit or debit. Do not forget to like, share, and subscribe. In addition to cash in a bank account, most people own some type of plastic, like a debit card, credit card, or combination of the two. What you do with these tools has serious repercussions on your ability to establish credit history and to avoid developing a borrowing habit. Conservative financial experts recommend either having only a debit card or having both, with the credit card reserved for occasional major payments and then immediately paid off. This advice is often given to people who have accrued a large amount of debt. Starting out with one of each card can help you develop responsible spending habits and provide convenience. Consider the rewards offered by both cards, especially if you travel or make large purchases often. The main advantage of only using a debit card regularly is you spend money you already have. Debit cards can be tied to your checking account where paychecks are automatically deposited. Debit cards have benefits like no limit on the amount of transactions and rewards based on frequent use. You have the ability to spend without carrying cash, and the money is immediately withdrawn from your account. Because using the card is so easy, it is vital that you don't overspend and lose track of how often you're spending with this account. If you're not paying attention, overdraft fees can drain your account. Some hotels, car rental companies, and other businesses require that you use a credit card. Getting an account designed for occasional use can be a wise decision. You can establish your credit history and take advantage of the time buffer between making a purchase and paying your bill. Another advantage of using credit is the added protections offered by the issuer. For online shopping and larger purchases, a credit card can be a safer option than a debit card. Relying on a credit card can lead to taking on serious debt. Should you choose to own a credit card, the best method of action is paying in full every month. It is likely you will already be paying interest on your purchases, and the more time you carry over a balance from month to month, the more interest you will pay. Saving. Saving is an essential component of good budgeting. Using a savings account allows you to prevent emergencies from draining the money you need for monthly bills and slowly build a reserve for making large future purchases. This reserve can be used for car repairs, apartment deposits, unplanned surgeries, and other medical needs, and even gathering funds for a home down payment. Some facts about saving. 67% of Americans have less than 6 months of expenses in savings. From 2011 to 2014, 24 to 28% of Americans had zero emergency savings. People ages 30 to 49 are the least likely to have emergency savings. 1 person out of every 5 people near retirement age has zero money saved. Make a financial commitment that you can keep, even if it means starting small, like $50 from every paycheck, or cutting out your gym membership for an extra $100 a month. Remember, this account isn't for splurging on the latest Apple product or Michael Kors purse. Be intentional about only using your savings for needs. Whenever you take money out, do your best to quickly replenish the withdrawal. Developing consistent savings habits allows you to leverage time, your age, your current resources, compounding interest, investments, and tax-advantaged savings. Saving tips. You set up a portion of your paycheck to automatically go to savings. Don't leave a savings account as your last financial priority. Debt. The trend of personal debt in America over the past 4 decades shows a slow but steady climb. A December 2014 Federal Reserve study revealed the average U.S. household has $15,611 in credit card debt, $155,192 in mortgage debt, $32,264 in student loan debt. In February 2018, Experian released its annual National Average Vantage Score. A representative credit score was 675, up from 666 in 2014. Still, it's much lower than the 800 rating that qualifies to get the best interest rates when it comes time to buy a house or car. The report also said the average consumer has a credit card balance of $6,354. Credit scores. The credit score can be a strong indicator of your financial well-being. Equifax, Experian, and TransUnion are the primary credit bureaus, and assign scores ranging from 300, high risk, to 850, low risk. The bureaus determine scores based on a group of factors which reflect your spending habits. Never underestimate the importance of credit scores. Once you are spending money with plastic and paying bills regularly, you begin your history. This record of how often you borrow, how quickly you repay, and how much you owe can follow you throughout your life. Credit score checklist. Make sure you know where you stand and address the blemishes on your credit reports. You can obtain a copy of your credit report for free once every year from each of the credit bureaus. Building a high credit score can help you get approval for low-interest loans, credit cards, mortgages, and car payments. When you are looking to move into an apartment or get a new job, your credit history may be a deciding factor. On the other hand, making late payments on bills, missing payments, piling on debts, and regularly maxing out your credit card can result in seriously lowering your credit score. Just as an excellent score can give you access to loans, jobs, and more, a low credit score can prevent you from being able to borrow more, pay low interest rates, and even get certain jobs. Using credit responsibly. Using credit cards is a way of life for most Americans. For some, it's a tool for building credit and borrowing money for major purchases. For others, it's a constantly refilling debt relied on for nearly every purchase. How many credit cards do you have? Experian's 8th Annual State of Credit Report, issued in February 2018, shows consumers have an average of 3 credit cards. Learning how to use these tools wisely has a major impact on your future, as potential employers may review your credit history, and credit scores can be used to qualify you for better interest rates when it comes to loans, mortgages, and applying for more credit. Choosing the right card. Many credit cards require you meet a minimum credit score for approval. The higher your score, the more perks you will qualify for, like low interest rates and a high credit limit. If you are a student, you may qualify for special rates. Decide before you apply for a card what your plan for using the card will be. Pay attention to introductory promotions, which may expire after 6 months to 1 year of owning a card. Making a game plan for credit use. Plan before you spend. You can become a responsible credit card owner by marking your calendar to avoid missing or being late for paying credit bills. Another precaution against getting in a borrowing hole is making sure you do not spend money you cannot repay, and keeping your balance well below the limit for your account. Ask questions. Are there points you will earn for regular use? Is the APR affordable? What kind of limits will you have? Find out what the fine print means before racking up debt you won't be able to repay. Paying off credit card debt. Getting control of your credit card debt requires taking a good look at how much you owe. Take a deep breath and evaluate what you can afford. You likely will need to define a long-term strategy for chipping away at the total amount you owe, while ensuring you don't dig yourself deeper into debt. Talk to creditors to find if they can work with you to make a plan that works. Only look into consolidation and settlement as a last resort. Student loans. Student loan debt is almost as routine today as a car loan or credit card debt. Few college graduates leave school without some sort of student loan to repay. Most students don't ask if they'll go to college, but rather where they will go. And it may not be until a few decisions later that they consider how to afford tuition. Years later, when school ends and real-world living begins, the afterthought of student loans takes its toll, and the bills start rolling in. Student loan facts. 40 million Americans have at least one outstanding student loan. Americans owe more than $1.2 trillion in student loans, making up 6% of the total national debt. The average borrower graduates from college owing $29,000. Paying attention to loans while you're still in school. In addition to signing the promissory note for your loans, take the time to examine exactly when your first payment will be due and how much it will be. Put that future date and cost on paper, and in the time between now and then, begin saving money to repay your loans. If you can work a few hours during the week, on the weekends or just holidays and summers, you can begin your post-college years with a surplus of money that can go directly toward loans. Do's and don'ts. You find out when your grace period ends. Don't miss your first payment because you forgot to mark your calendar. Staying in control when you leave or graduate. When the time to start paying comes, you have options for a payment. The federal government offers longer-term payment plans as well as graduated repayment options which allow you to bulk up your income and get some job experience under your belt before making larger monthly payments. From there, your next step will be making payments on time and reducing the principal, if possible by paying more than the minimum that is due. For public service careers, you may qualify for loan forgiveness. Do's and don'ts. You make more than the minimum payment to reduce your principal. Don't skip payments or accrue late fees. When repayment isn't an option. During certain seasons of life, your income may be severely limited, and affording student loan payments just isn't possible. Fortunately, loan servicers are aware that situations like this occur and have precautions in place to help students get through these difficult times. Qualifying circumstances, like unemployment or health problems, can make you eligible for deferment or forbearance, which allow you to temporarily postpone or reduce payments. Contact your loan servicers to find out your options. If you just ignore loan bills, your account may receive delinquency or default status. Do's and don'ts. You communicate with lenders if you are unable to make payments. Don't ignore student loans when you're struggling financially. Real estate. Owning property is a normal goal for a sound financial plan. Homeownership not only develops a sense of achievement and pride, but also builds equity. It is also a major financial undertaking and a long-term investment. For many people, buying a home is the biggest purchase they will ever make. Unfortunately, more and more people find themselves forced to put off this purchase. Student loan debt, underemployment, rising home prices, and stringent mortgage standards prevent people from buying their own homes until later in life. Before signing a mortgage, make sure to calculate all costs and leave some savings untouched for after you buy. Homeownership often comes with a slew of added expenses like taxes, insurance costs, emergencies, and necessary repairs. You want to have more than enough to barely make it by. Often getting approval for a decent mortgage rate requires waiting a few more years to save up for a larger down payment. The planning stage before buying a house is lengthy. Prospective buyers work hard to get to a place where they can find their permanent home. The process is long and involved, demanding most people to build up their credit scores, save up for a down payment, commit to a stable job location, earn an income that qualifies for a large enough mortgage, choose a good realtor, find a suitable place to live, find a home inspector, then have an offer accepted. Home ownership in the United States. The average home buyer searches 10 weeks and views 10 homes. The median price of a single-family home in 2018 was $261,600. The average price of a new single-family home in 2018 was $299,400. In April of 2014, homeownership for all ages fell to 64.8%, the lowest it's been since 1995. Foreclosures and short sales. A foreclosure occurs when borrower cannot make mortgage payments, and the lender is legally given the right to take possession of collateral property. A short sale occurs when profits from selling a home are less than debt remaining on a mortgage. In this case, the lien holder often agrees to release the debtor of the remainder of the loan. On the other side of this coin is an opportunity for buyers looking to purchase a home at a discounted rate. While it might take more paperwork and some hoops working with a bank to get the sale approved, these homes can be discounted as much as $60,000. RealtyTrack, a real estate information company. Have a home inspected before proceeding with the purchase, as these may require extensive repairs, remodeling, and insurance. Business finance. Startups are sweeping the nation. With the burgeoning tech industry and the deconvenience of using the web as your storefront, entrepreneurial ventures have become commonplace. A University of Phoenix survey found 63% of adults in their 20s want to run their own businesses. Small business facts. Around 400,000 new businesses open every year. The SBA defines small businesses as those with less than 500 employees. Top fastest growing sectors in 2014. Electronic shopping and mail order houses. Software publishers. Computer systems design and related services.